have you ever been there? You're diving into something new, maybe market analysis, maybe, I don't know, a complex game strategy,
hmm
and you feel like, okay, I get this now. You see the pattern, right? You spot the signal, try to use it.
And it just falls flat.
Completely, yeah. The market or whatever system it is just seems to shrug and do its own thing. It's so frustrating, isn't it?
Oh, absolutely.
Especially like in trading, when you spot a fair value gap, you expect something specific to happen.
And poof, ignored. You're left just scratching your head.
Exactly. Leaves you wondering what went wrong.
It's such a common hurdle, moving from just knowing the theory to actually making it work in practice.
Right. Mm-hmm.
And usually it's not that the idea itself is bad. It's more often, well, you're missing some key context maybe,
Yeah.
or misinterpreting the situation.
Or maybe overlooking the exact conditions where it should work.
Precisely.
Yeah.
You see powerful tools get misapplied all the time because those little nuances get skipped over.
That makes so much sense. So today, in this deep dive, we're going to tackle that exact frustration. We're really digging into why these fair value gap misreads happen.
Good, because it's key.
It's not that the FVG concept is wrong, right? It's about how it's being used, or maybe more accurately, misused. And just quickly, for anyone maybe newer to this, a fair value gap, or FVG, it's basically an imbalance, like a little void left when price moves super fast one way.
Yeah, it looks like an empty space on the chart between candles.
Right. And the idea is that price often comes back later to, like, fill that gap or react to it somehow.
And for this particular deep dive, we're focusing on just one source. It's really insightful, actually. It's the, quote, roundup episode script, what ICT actually says about FVG misreads.
Okay.
And this script, it has this dialogue like a teacher and a student. It cuts right to the chase about the common mistakes people make.
Ah, the teacher-student format. That's helpful.
Yeah. And, that ICT reference, it points to a well-known voice in trading circles who really stresses a precise, a very context-driven way of looking at these market things.
Moving beyond just seeing a pattern.
Exactly. Much deeper than that.
Got it. So our mission today is pretty straightforward then. We're going to pull out the core ideas, the really specific disciplined rules from this teacher. The goal is to help you, our listener, sidestep those common FVG mistakes. Think of this as maybe a shortcut, a way to approach these insights with way more precision.
And discipline, that's crucial too.
Absolutely. Discipline. Okay, let's dive in. What does the teacher tell us first?
So the teacher, in our source, they jump right into the fundamental problem. They explain that, when you mark an FVG on your chart, and price just seems to blow right through it, or doesn't react like you thought it would.
Which happens.
It happens. But it's not because FVGs just plain don't work. It's usually because they're being read wrong or traded completely out of context. The teachings, as they emphasize, are apparently very specific about when an FVG is actually a high probability setup.
Versus when it's just a gap.
Exactly. Just a gap in price that might not mean anything for a trade right then.
That immediately rings true, doesn't it? Because you see the gap and your brain just lights up. Opportunity.
Right. Alarm bells, but maybe the wrong kind.
But the teachers is basically saying, hold on, wait a second. And they give a foundational rule straight off. They state quite clearly.
But the bias is bearish. So if the bias is bearish, would you go in looking for a bullish fair value gap?
No.
The bias. Okay.
So what's the key takeaway there? What's essential about bias?
Well, what's really illuminating is how that one statement clarifies something absolutely critical, the higher time frame bias.
Okay, the bigger picture.
Think of it like the market's main current. Its overall direction where it's generally expected to go.
Right.
So if that main current is strongly bearish, strongly downwards, you just shouldn't be looking to buy off a bullish FVG, a gap pointing up.
You'd be fighting the tide.
Exactly. Trying to swim upstream against that dominant flow. And naturally, the reverse is true too. If the overall bias is bullish, upwards.
Don't short a bearish FVG.
Precisely. Don't sell into a gap pointing down. This isn't just like a suggestion. It's presented as a fundamental filter you have to apply to every potential FVG setup.
So it's not enough just to spot the FVG pattern itself.
No.
Step one is really nailing down the market's bigger story, its underlying direction. If you try to trade against that dominant narrative...
Even a perfect-looking FVG is shaky.
Yeah, I've definitely seen traders fall into that trap. They get hyper-focused on the little pattern and ignore the huge wave the market's riding.
It's all about context. Context over isolated patterns.
Okay, context first.
And the teacher digs even deeper into that. They set up this scenario asking, you're looking for a fair value gap. Do you see a fair value gap of? Yeah. You would say that, yeah, I didn't know that you read my mind. Icked. Why not that one? What if that? What would happen if I went into that and sold? Well, first of all, if you did that, you were not following the rules. Because from this high down to that low, this is equilibrium we need to get.
Okay. What does that tell us about just, jumping into any FVG we see? Because that urge is strong.
It really is. You see a gap, you want to trade it.
Yeah.
But what the teacher is highlighting there is crucial. Not every FVG you can visually identify is actually a valid trade entry according to their rules.
Ah, so there are other rules besides the bias check.
Yes, specific conditions like whether the market is in what's called a premium or discount area relative to the recent price range, or respecting equilibrium.
Okay, let's unpack those terms. Premium, discount, equilibrium.
Right, so equilibrium is basically the midpoint, the 50% level of a recent price swing, like the balance point.
Makes sense.
If the current price is above that midpoint, it's considered premium. Think of it as expensive, maybe overbought territory. Might attract sellers.
Okay.
If price is below equilibrium, it's in a discount. Think cheap, maybe oversold, might attract buyers.
Got it. And the dealing range.
That's just the specific price swing, the highs, low that you're currently analyzing for these premium discount zones and potential trades.
So the teacher is saying, don't just jump on an FVG. You have to check if it's in the right zone first. Like a bearish FVG should be in a premium zone.
Exactly. And a bullish FVG should be in a discount zone. If you just blindly enter any FVG without validating it against these rules,
you're not following the model.
Right. It becomes, as the teacher implies, a misread. You're shifting from a rule-based approach to something much more random, to sort of guessing at every gap.
And this strict adherence to the rules seems like a really big deal for the teacher. They emphasize, if you do anything other than this, you're not going to get the results you're looking for, and you're not going to find my IC fair value. Got okay.
Yeah. That sounds pretty firm. Like a warning.
It really does. It sounds like a strong caution against mixing strategies or trying to improvise on their specific method.
Absolutely. It really underscores how important it is to stick to the precise definition and application of the fair value gap concept as it's taught in that specific framework.
Don't tweak it.
Right. If you start deviating, or as they put it, if you add something else that some other educator has taken my stuff and twisted it up, you just won't find the high probability setups they're talking about.
So a common misread is essentially not using the tool purely as intended.
Exactly. It's about that purity of application. Using the tool exactly like the instructions say, without adding your own bits or stuff from elsewhere that might actually mess it up.
Okay. No mixing and matching, no winging it. Ignore the noise, stick to the rules. That takes serious discipline.
It does.
But sometimes, even if you are sticking to the rules, the market itself can be confusing. The teacher mentions this too. When you have this condition, consolidation around equilibrium, it can make it very difficult to get a true reading on bias. Okay, so there's times when even me as ICT, I don't have a good, clear read on what it is I'm looking for. So I have to demand more price action and more information, or intel, as I like to call it.
Consolidation. Sideways movement.
Right. This sounds like knowing when not to trade is just as vital as knowing when to trade.
That is such an important point. When price is just chopping sideways, consolidating, especially around that equilibrium level.
Pin beat.
Yeah. The market's direction is just unclear. It's murky, like trying to navigate in thick fog.
You can't get a clear signal.
Exactly. So in that kind of environment, even an FVG that looks technically perfect might not be reliable. The underlying bias is just too ambiguous.
So you need to wait.
You need patience. You have to wait for the market to show its hand, for the fog to clear, basically, to reveal the real directional bias.
So trading an FVG when the market's just chopping sideways, even if the gap looks good, is a major misread.
A significant misread. Because you don't have that confirmed bias backing it up, sometimes, yeah, the smartest move is just sitting on your hands.
Doing nothing, which is hard. Especially when you see that gap tempting you.
Very hard. It requires incredible patience, incredible discipline, things often glossed over when people are eager for action.
And getting that bias right, which the teacher says is foundational. It sounds like it's not simple. They apparently get asked a lot, and I'm quoting, "Can you just tell me how to determine the bias?" And I'm telling you again, it's always the same response. No one look at that. It takes a lot of other supporting lessons to get good at the bias.
Right, so it's not just one simple trick or indicator.
Apparently not.
And that's fascinating, isn't it? acknowledging that figuring out the market's bias isn't something you learn in one go from one video.
It's layered.
Very layered. It involves understanding higher time frames, looking at the daily chart, the weekly chart, to see the big picture trend. It involves understanding liquidity, where big pools of buy and sell orders are likely sitting, even factoring in major economic news events.
Wow, okay, so it's a synthesis of many things.
It requires consistent study, a lot of screen time, and being able to connect multiple dots.
Yeah.
An FVG misread very often starts with getting the daily bias wrong.
Because if you get the bias wrong.
Any FVG trade based on that wrong bias is likely doomed from the start.
Yeah.
It's like, yeah, building your house on sand, the foundation is just not solid.
So FVG's success hinges massively on getting the bias right, and getting the bias right takes a lot of work. Definitely not a quick fix.
Not at all.
And then finally, the teacher brings up a really fundamental truth, something a lot of aspiring traders probably bump up against. They state, every single market isn't going to give you that model's entry setup and framework every single day, every single session.
Managing expectations, that's huge.
Yeah. It directly challenges that assumption many people have, doesn't it? That there must be a perfect trade setup every single day.
Right. Or even every trading session. But the teacher's saying, no, that's just not realistic. These models, FVG included, are specific. They need the right conditions.
The stars need to align, so to speak.
Pretty much. If the market isn't offering up those precise conditions, then yeah, an FVG might just be a gap. It might fill, it might not, but it's not necessarily your trade setup.
So discipline here means waiting.
Knowing when not to trade. Even if you see a gap that looks like an FVG, it's about letting the market come to you, waiting patiently for your specific high probability setup.
Instead of trying to force a trade when it doesn't quite fit the rules.
Exactly. Not every gap is an opportunity. Recognizing that protects your capital, protects your mental state too.
That's a massive point about patience. Letting the model confirm the FVG,
Yeah.
not just seeing a gap and jumping.
Mhm.
Okay. And then there's the last piece, really. Understanding when a setup is no longer valid.
Right, invalidation. Crucial.
While discussing something called order blocks, which sounds similar conceptually, areas where big institutions likely placed orders.
Yeah, similar idea.
Yeah.
Represents potential institutional interests like FVGs can.
The teacher highlighted a principle that seems to apply broadly. How do you break it down? How do you invalidate the certain parts of the order block? How do you know it's not going to go in the upper half of the order block or the last up-close candle before it goes down?
Okay, so applying that idea of invalidation to FVGs.
Yeah. How does that work? When is an FVG no longer good?
That's absolutely paramount. You need to know when the market is basically saying, nope, not respecting this level anymore.
Right.
For an FVG, a key sign of invalidation could be price trading decisively through its midpoint, its mean threshold.
So the 50% level.
Yeah. If price pushes strongly past that halfway point, or even worse, if the whole market structure shifts, like if it makes a new significant high or low that goes against the direction the FVG suggested,
Then the FVG has probably lost its juice.
it's likely lost its predictive power, yes.
Yeah.
Recognizing those invalidation signals stops you from stubbornly holding on to a trade idea the market is clearly shouting against.
Which is another common way to misread an FVG and take unnecessary losses.
Definitely. It's not just when do I get in? It's also when is this idea clearly wrong and I need to get out or stay out?
Okay, that really rounds it out. Knowing the entry rules, the context, the bias, and the invalidation points, that gives you a much more complete framework.
Exactly. And, to really hammer this home, the teacher in our source suggests a practical exercise, a mini drill you can do.
Oh, good. Actionable steps.
Yeah. Go into your own charts, your own data, any time frame, and find, say, at least 3 times where you saw a fair value gap form.
One that maybe you were tempted to trade or perhaps even did.
Exactly, but it ultimately failed. It didn't perform as expected, price blew through it, or reverse weekly, whatever.
Okay, find those failed FVGs. Then what?
Then, for each one you find, ask yourself some really specific questions based on what we've discussed.
Right, like what?
First, was the higher time frame bias really aligned with the FVG's direction? Or was it kind of murky, ambiguous, or maybe even pointing the opposite way?
Okay, check the bias alignment. What else?
Second, what was the market doing when the FVG formed? Was it in a nice, clear trending move? Or was it just chopping sideways, consolidating?
Check the market condition. Trend or chop. Got it. And third.
Third, did price violate a key level before reacting? Or instead of reacting, did it smash through the FVG's midpoint, the equilibrium? or take out a nearby significant high or low, signaling the FVG was probably invalid.
Check for those invalidation signals.
Okay, and then, crucially, log these examples. Write them down in a study journal. Note the specific reasons based on these rules, why that FVG was likely a misread or just not a valid setup to begin with.
So it's about actively diagnosing the failures using these principles.
Precisely. That exercise trains your eye. It helps you filter out the low probability trades in real time and builds that essential precision and discipline.
That makes a lot of sense. So wrapping this up, what's the big takeaway for you, the listener?
I think ultimately mastering fair value gaps, or really any kind of specialized knowledge, is way beyond just spotting a pattern.
It's not just pattern recognition.
Not at all. It demands that deeper, holistic understanding of the context. It requires sticking rigidly to precise rules. And, maybe toughest of all, having the discipline to know when the conditions aren't right, and you just need to wait.
Precision over just recognition. Discipline over impulse.
That's it. Keep refining that understanding, keep doing those reviews, and your approach to these market insights can shift from being kind of hit or miss.
To something much more deliberate and consistent.
Exactly.
You know, this whole deep dive really makes me think, what other concepts, maybe in your job or just in life generally, might you be misreading?
Good question.
Are there areas where you might be missing the crucial context, or not sticking to the actual rules needed for success, or maybe just lacking the discipline to wait for the truly right conditions?
Applying that same critical lens elsewhere.
Yeah. It feels like a way of thinking that goes far beyond just charts and markets, doesn't it? Something to chew on.